Hey guys, welcome back to my channel, and this will be a new segment where I will talk about a subject that resonates closely to my heart, and that is the stock markets. So today let's understand why the bulls are rallying despite poor economic forecasts all over the globe. But before starting, I request you to smash that like button and hit the subscription button down below. So without further ado, let's get going. Firstly, let's try to understand how the world economy looks like. The world right now is going through a pandemic, and now it is certain that we are living through one of the most unprecedented events in modern history. The past few months we witnessed have spawned various new predicaments, and in just a few months we've made drastic changes on how we live and function. Every walk of life has been affected by this pandemic. Not only lives, but this pandemic, with the economic shutdown, has disrupted the livelihood of billions of people, jeopardizing decades worth of development progress. Now, according to Global Economic Prospect of June by the World Bank, this pandemic is expected to plunge a majority of countries into recession this year, with the per capita output contracting in the largest fraction of countries since 1870. Advanced economies are projected to shrink by 7% in 2020, and emerging markets of developing economies like India is expected to contract by 2.5% in 2020. This dip in number would be the lowest rate since the 1960s. And this is how the data looks like. The global growth is expected to shrink by 5.2% this year, making it the deepest recession since World War II. Mind you, this was 8 decades earlier and is almost 3 times as steep as the 2009 global recession. Also, debt levels are at a prehistoric high. Since the lockdown, many businesses have been forced to shut shop, and this prolonged disruption in domestic activity has led to these businesses to work with debt money. This data here reports the latest debt pile. Now, with such weak data, economists all over the world are suggesting a recovery that is very sluggish, hampered by severely impaired balance sheets, heightened financial market stress, and widespread bankruptcies. But what's intriguing and interesting to analyze here is even with such bad economic data, the stock market seems to have been recovering from the March-April levels, where the markets crashed 40% in just a span of 1 month. So what has been fueling the markets that even in such dire times, the market seems to be doing just fine? Let's look into 3 reasons which has allowed the stock markets to hold its ground for the time being. Number 1, quantitative easing. You see, quantitative easing is nothing but a fancy term for printing money. You see, this printed money is then used by the central banks to buy government assets such as bonds and other securities from the market. This is done to ensure that money flows into the economy. Now, ensuring that money flows into the economy is very important. A country functions and thrives only when citizens spend more of their money. So in the hopes that people will borrow money and resume economic activity, this unconventional monetary policy is implemented. And this is what we've been observing so far, with countries injecting fiscal policies worth trillions of dollars like this, and this, and this, and on top of that implementing quantitative easing measures like this. All we can say for now is that there is money in the markets, and this new money has been one of the reasons responsible for what I call a temporary recovery. Number 2, the trading euphoria. The recent reports suggest that there has been a substantial increase in the trading volume, not just retail trades. Even the hedge funds are flooding into the stock markets, and according to Citi reports, the stock market euphoria has hit the highest since 2002. The conventional wisdom is that the institutional money, pensions, insurance companies are the likes that drives the stock market. But there are signs that retail traders have increased so much that their influence is probably getting close to the scale of institutional trading. Brokerages like Charles Schwab, Interactive Brokers, and TD Ameritrade added more than 1 million new accounts in the first quarter, a 4% increase from the previous year. A year ago, that increase was just 1%. Robinhood, a popular brokerage app, said last month that it had added 3 million customer accounts this year, bringing its total to more than 13 million. One theory is that bored gamblers with little access to sports betting thanks to social distancing, are the reason for the explosion in retail trading. The retail trading frenzy isn't without controversy. Nevertheless, the markets have been showing substantial recovery contradicting to all economic data, and this could well be one of the reasons responsible. Number 3 would be the economy bottoming out. Now, another reason for this positive movement can be traced to the positive reports suggesting that the economy was bottoming out. After the March and April bloodbath in the markets, we saw massive layoffs and skyrocketing unemployment numbers, where there were 40 million jobs lost only in the US. But the recent data suggests that this situation is improving and consumer optimism is slowly shifting due to the unlock measures. People are asking, when will the bars open? When can I go to restaurants? When can I go shopping? And to point, this shows consumer confidence. It's true that consumer confidence had definitely dropped, but it's nowhere near the lows compared to prior recessions. But that being said, it's not like we're out of this predicament that we're in. Although there is some optimism in the market, it is still a bear market. I mean, the data clearly shows us the picture, and by the look of things, we should be expecting a slow recovery. Being cautious and smart analysis can help you make the correct decision and prevent you to jump on the bull train that everyone seems to be riding on. So my advice would be not to get carried away and always stay alert, taking profits at short term with a definitive stop loss margin. With this, we've come to the end of this video. I hope there was something you could take from this video, and if you like my content, please hit a like and the subscription button down below. I'll come up with more content. Until then, bye.